Welcome to the next session. And in the last session, we saw that we were working on this Abacus case out there with regard to what is called as the break-even and looking at an option where it would be more feasible for the organization to sort of operate the organization or run the organization, because as you would have seen we go back to the same slide out there, we go back to the same slide out here, we saw that the organization was making a loss out there and they had some about 4 to 5 different options of turning around this entire organization. That is, trying to see which of the 4 or 5 options would be basically feasible for them so that they are not in the red, as you could see as of now. So what did we do? We went ahead and we looked at what is the case 1 part of it. We just calculated whatever was there given in the previous slide out here. We just divided that into fixed cost and variable cost part of it, and we arrived at the profit. The reason for doing that was, I'm just going to pull this Excel sheet out there. The reason for doing that, this is what we did, and the reason for doing that was very simple, in the sense that we know the fixed cost does not vary with the alternation with the variation with the units out there, number of units you produce, whereas the variable cost varies with the number of units. So one possibility, can I increase the number of units and make it more profitable? I don't know. Number 2 is, we also wanted to know what is it that every unit that you manufacture is contributing towards covering the fixed cost and the profit out. What is the amount that every unit you manufacture is give you for the contributing for the covering the fixed cost and the profit. So based on that, we went ahead with the second option out here. We went ahead with what is called as, there are 2 options what we tried out here, option A and option B. Under option A, we studied that we just cut the price by 15% so that we can operate at full capacity, and then we tried to work out whether you are profitable or not. We tried to see that. Under option 2B, what we saw was, we said that increase the price by 25%. That is one option which they are trying. And as well as increase the ad budget by 150,000 or 1,50,000 and try and see if you are profitable or not. And we basically tried to calculate that out here in this particular case. We said that 2A, I have decreased the price by 15% out there. I have decreased the price by 15%, that is for 4.25. And then I kept all these costs out here. And then I have tried to see whether I make a profit or loss. It becomes worse for me, because my loss significantly enhances when I just cut the my price by 15%, and even though I fill my capacity out there, it is basically what happens, my contribution per unit, which was 1.51, drops to 0.79 in this particular case, and it is not sufficient. So I looked at option B, where I said I'm going to increase the price by 25%. That is what we have said, increase the price by 25%. And then they also talk about increase the price by 25%, advertising budget, and boost sales commission by 20%, 10%. And then this will increase the volume by 50%. What is the volume here? Earlier it was 90,000, so it has become 135,000. 50% increase. Price has increased by 25%, $5 rupees to 125%, 6.25. Kept all these costs. We looked at the sales commission, which was at 4%. Now it is at 10% is the sales commission what we see out here. And then we see that my contribution is higher at 2.34. My ad budget is also increasing, and then I sort of look at my fixed cost increases, and I make a profit of over 24,825 in option 2B. So among the current operation, option 2A and option 2B seems to be slightly better in this particular case. We look at the next options out there. I'm just going to hide these so that it's easier for me to operate I'm just going to hide these columns out. Now I move to the next option out here. Option 2B is finished. We saw that option 2B is finished. Let us look at option 3 out. When we see option 3, we see that the president of Abacus Limited does not want to tinker with the price. he wants to maintain the same $5 as the price. How much may the advertising be increased to bring the production and sales up to 130,000 so that you will earn a target profit of 5%? See, there are a lot of complications. He says that ad also I am prepared to increase. I want to sell 130,000 units, but I want to earn 5% profit on sales out there. So how much is the leeway for increasing that? Now let us look at that. Let's go back. In this particular case, let us sort of see this. In this particular case, what is the number of units? He says 130,000 is the number of units he wants to sell in this particular case out there. What is the selling price per unit? Selling price per unit is $5. So what is the total sales value out here? My total sales value is 650,000. And they clearly indicate out here, he does not want to tinker with the price. That means he doesn't want any change in the price out there, but he wants to increase the ad budget. So let us go back and look at the variable costs out there. All these variable costs which are all there is going to continue at the same level. The variable cost per unit is not going to change at all in this particular case. The variable cost out there is not going to change at all in this particular case. So what is the total of my variable cost? My total of my variable cost is so much. What is my contribution per unit? My contribution per unit is also going to remain the same. That is fine. What is my total contribution? I would say if my total contribution is going to be this into the number of units that I am selling, that's also fine. 1,96,300. What is my target profit out here in this particular case? Advertising budget can be increased in this particular case. The answer what you see is already here. I'm using the existing slide out there. So existing Excel sheet out there can be increased by, I've just kept it. What is my target profit? My target profit is 5% of the sales, because what does he say? 5% of the sales. What is my target profit? My target profit is 5% of the sales out there. What is my sales? My sales is 650,000 into 0.05 is what I need. So I need a target profit of 32,500 is a target profit that I have to get out. What is my fixed cost as of now? My fixed cost as of now is 140,400 is the fixed cost as of now out. So what is the surplus I have? That is the surplus I have after deducting the fixed cost out there. 1,96,300 is the contribution. Fixed cost goes, and then the desired profit also I deduct out there. So what happens? My surplus that I have after covering the fixed cost and the desired profit, as you can see out here, is about 23,400 is there. Now how did I get it? Very simple. 1,96,300 is the contribution I have. What is the fixed cost? My fixed cost is 1,40,400. What is the desired profit I have? 32,500. So what is the surplus? Surplus is 23,400. So advertising budget in option 3 can be increased by rupees 23,400 maximum out there. So it answers this particular question out there. The president of Abacus does not want to tinker the price. How much the advertising budget be increased to bring the production sales to 130,000 per unit, 130,000 units, so that you will earn a target profit. Maximum you can increase is 23,500. Now, sir, is this not a better option? I don't know, because the leeway you have in advertising increasing is only 23,500. Maximum you can spend only 23,500 for increasing the ad. If you increase the ad budget by 23,500, whether you will reach that 130,000, that the organization will have to decide. If it is possible, well, then this is one of the profitable options to consider out there. If you find that it's going to be difficult, then this is an option which I'm not even going to consider out there. Now what happened? Now I know this is the extra leeway I have. 23,400 is the extra leeway I have. By spending 23,400 more, can I reach a target of 130,000? That's all. What is the question? That is the core question that I need to ask now. I need to ask my sales team. I need to ask my marketing team. Whether I can spend extra 23,500 and increase the sales from 90,000 to 130,000, increase the sales by 40,000 units out there. Well, that is something, the call which you have to take out. Now I look at the next option. I look at the fourth possible option. The fourth option is very different. It says that the government department is willing to buy 60,000 units of the product. Fantastic. That reaches the capacity because you are operating at 90,000. If government department picks up 60,000, 150,000, it reaches the capacity. If the price is right, assume that the present market of 90,000 units at $5 each or 5 rupees each will not be disturbed. Abacus will not have to pay any sales commission on this order. The government department will pick up the units directly from Abacus India Limited ex-works. However, Abacus must refund 24,000 of the total sales price of this order to subsidize a safety promotion campaign launched by the department. In addition, special packaging showing the government's name instead of Abacus will increase the manufacturing cost by 10 paisa per unit of the 60,000 units. At what unit price must the government department be quoted for Abacus Limited to break even on total operations of 2021? Now let us see if we can try and solve this part of it. Let us take this as an option out there. Now what is the option out there? Option is I am selling 60,000 units out there. I am selling only 60,000 units. Now what is the price at which I am going to sell? Let me not worry about the price at which I am. Let me worry about the cost. What is the cost going to be? Direct material cost? Yes. Labor cost? Yes. Variable overhead? Yes. Out there, all these three costs are going to be there. Certainly yes for the 60,000 government order. This is what, let me say, government order. Sales commission is not going to be there, it's going to be 0. Shipping cost is not going to be there because they are going to come and pick up, because as you would have read in this particular case, they say that the government department will pick up the unit directly from Abacus India Limited, so you don't have what is called as a shipping cost in this particular case. Variable admin overhead, yes, 0.05, that's going to be there out here. Now what is going to be my total variable cost for manufacturing this particular order out there? The total variable cost is going to be 3.25 for manufacturing each unit of 60,000. Is that all? No. There are other costs that are added to it out here. There are other costs that I will have to sort of add to it out here. There are other costs that I'm going to add to it out here. Let me start with that. What are the other costs? That is, it says that if I see this, it says that special packaging with government's name is going to increase the manufacturing cost. Now let us look at special packaging cost. Special packaging cost for this unit is going to be 0.10 out there. Then you have to have one more aspect out there, that is, must refund 24,000 of the sale price in order to subsidize a promotional campaign launched by the government. You know that 24,000, that is extra cost for subsidy a government campaign. What is the cost out there? That is going to be 24,000 is the total cost out here. That is going to be borne by how many units? 60,000 units out there. So it's about 0.4. So my total cost of manufacturing, total cost per unit for manufacturing 60 of manufacturing the government order is going to be what it is. It's going to be this plus 3.25. This is basically the cost out there. Now what is the objective? The objective is, it says that in this particular problem, they say at what unit price must the government order be quoted for Abacus Limited to break even on total operation, that is no loss, no profit. Please note, there is no fixed cost for this order because all the fixed costs are borne by the existing 90,000. It says that 90,000 units will not be disturbed out there. So what happens? All the fixed costs are borne by those 90,000 units. So you are not worried about fixed cost. So in order to break even, what do you have to do? The current existing loss will have to be shared by the government order to break even. What is the existing loss you have? The existing loss I have is 4,500. That divided by how many units? 60,000 units out there. That is all what I am basically looking at in this particular case out there. So what is the price at which I will have to sell the government order? The price at which I will have to sell the government order is 3.83. That is the sale price, desired sale price for the government order to break even is 3.83. That's all. So that this loss also I'm adding to it. So if I sell it at 3.83 for the 60 units of the 60,000 units of the government order, I make no loss, no profit in the case out there. That is what I break even. Let's go to the next one, 5th and 6th. The president's daughter, who is a recent graduate from a prestigious design institute, thinks that a fancy new package will aid in getting more sales. Beautiful. Present packaging costs per unit are all variable and consists of 5 paisa direct material, 4 paisa direct labor. New packaging cost will be 30 paisa and 13 paisa respectively. Assuming no other changes in the cost behavior, how many units must be sold to earn a net profit of $20,000, 20,000 rupees? Let us sort of look at it. Direct material, it is 5 and 4, it becomes 30 and 13. Let's go back. Now what happens if in this particular case, what is the present packaging cost? So we are not even looking at in this particular case number of units. She is not talking about. We will aid in getting more sales. That is all what we have talked about. No the changes in the cost behavior. How many units will be sold to earn a profit of 20,000? Let's look at how many units will out. Now we don't know the number of units. We know that the selling price is going to be about $5 because I don't think she is not changing the price anywhere. That is present packaging cost. The order doesn't, our precision thinks that in fact they will get more sales. Present packaging costs are variable and so on and so forth. Assuming no changes in the cost behavior, no change in the cost behavior out there. Now let us look at. In this particular case, direct material was earlier ₹2. This contained, what is the packaging cost it contained? It contained a packaging cost of 0.05 earlier packaging cost. So that is not going to be there, I am knocking off. Instead, it's going to have a packaging cost of 30 paisa out there. That is what it says. Instead, it's going to have a packaging cost of about 30 paisa out there. So I have added this 30 paisa out there, reduced that 0.5, and this is going to be the new material cost. My labor, which was $1 out here or 1 rupee out there, had a packaging cost of 4 paisa. That is not going to be there. Instead, there is going to be a 13 paisa addition out there. So it's going to be at 1.09. My factory overhead is just going to remain the same out here. My sales commission is going to remain the same at 4%. My shipping cost is going to remain the same out there. My variable admin overhead is also going to remain the same in this particular case. So let me look at what is my total variable cost. My total variable cost is 3.83. So what is going to be my contribution? My contribution per unit is 1.17. Now let us go to this. What is the desired profit? As per option 5, 5, the desired profit as per option 5 is about 20,000 rupees is the desired profit that you basically have out there. The desired profit as per option 5 is going to be about 20,000 rupees. I am just going to hide these so that it becomes easier for me to write. As per option 5 is 20,000 is the desired profit out there. Now, what is the fixed cost? My fixed cost is the same 140,000 out here. So, what is the total? What is the number of units I have to sell? The number of units I have to sell to earn desired profit is nothing but what is the fixed cost? Fixed cost is 140,400 plus what is the desired profit? Desired profit is 20,000 divided by my contribution per unit out there. So, what happens if I sell about roughly 137,094 units or 95 units out there, I will make what is called as a desired profit of 20,000. Sir, now we want to verify that. We will verify it. We will verify this. We will verify this. There could be some decimal issue, so don't worry about that. I mean 24 instead of 94, we make it 95 out there. That is, I will say. So what happens? What is the total contribution for the desired for the units that you have arrived at? That is going to be, I am going to say 137,095. That is why I am typing, because I just want to increase, because there are decimals out here, into 1.17. So less your fixed cost. What is your fixed cost out there? Fixed cost out here is 1,40,400. So what is the net gain out here? The net gain, you see, it's basically the profit, which is equal to desired profit. That not 1 is because of the decimal. If you look at 2.137,094 into something, you would have got the exact amount. So that is what is question 5. So let's go back to question 6. If selling price increases by 10%, commission also increases by 10%, and the desired profit is 30,000, how many units must Abacus sell? Now this is the sixth one out there. Selling price increases by 10%, commission also increases to 10%, desired profit is 30,000. Now please note, let us sort of look at the sixth option out there. I am just going to, I have not made the, so let me hide this. Now let's go to question number 6. What does he say? He says selling price increased by 10%. So selling price, this is the $5 is the selling price into 110%. Now this is going to be the new selling price. Now all these are fine. These costs are going to remain exactly the same out there. These costs are going to exactly remain the same out there. So I am just going to keep it as $2, $1, $0.2 out. Commission increased to 10%. So this is the sale, and this into 0.1, this is what is the commission out there. Shipping cost is going to remain exactly the same out here, and then my variable overhead is 0.05. This is also going to remain the same. So let me see what is going to be my total variable cost out here. This is going to be my total variable cost. What's going to be the contribution? Yes, this is going to be the contribution out there. Now I will go back to question number 6 out here, that is option 6. Option 6, desired profit. Desired profit in option 6 out here in this particular case is 30,000. Now what happens? Number of units, if I have to sell, that is in this particular case, number of units I have to sell to earn the desired profit out here. That means I will say this is going to be fixed cost plus my desired profit divided by my contribution per unit out there. Fixed cost plus desired unit 1 to contribution out there. That is all. Now what happens? The fixed cost column is vacant. I have to just fill the fixed cost out here. The fixed cost is going to be, this is the fixed cost. So once I have this, now what happens? If this happens, if I sell 1,02,651 units, I will make a profit of 31,000 out there. Now let us verify. Now let me verify this. I am just going to verify this. Total contribution for units that you have arrived at, that is going to be 1,02,652 into what is going to be your, that's purely because 1.66. Now less fixed cost. Fixed cost is going to be out here. It's just going to be, this is the fixed cost out there, and that's going to be your desired profit out here. Desired profit equals desired profit. That change, small change you are getting, that is because of the decimals out there. That's all. I have all the 6 options worked out on the same Excel sheet out here. So it basically gives you some kind of a comfort zone with regard to break even, with regard to your variable cost, with regard to your fixed cost, with regard to your calculating your desired profit, and so on and so forth. Okay. So further, what we are trying to do is, we can say in this particular case, what did we, in the Abacus case, what did we see? We saw that different kind of decision. What we made? The sales, the pricing decision, the core, the pricing. How do I price the decision, price the product out there by making various alterations out there. We sort of worked out about 6 options. Sir, is it going to be only 6? No, you can develop even 60 different options. Nobody is going to stop you from doing that, as long as it's going to be workable out there. So various kinds of decisions is what you can do with what do you call it as cost accounting. To sort of work on that, let me take up a series of simple problems out here. I've just uploaded all these in-class problems out there. There are about 5 or 6 different problems out here. I'll get more, and let us try and see if we can solve it. Let us look at the first one. The first one is very simple. A study is been conducted to determine if product A should be dropped. That is, dropping a product or not dropping a product. Sales of the product is about total about 200,000 per year. Variable expenses is about 140,000 per year. Fixed expenses charged for the product is about 90,000 per year. The company estimates that 40,000 of these fixed costs will continue even if the product is dropped. These data indicate that if product A is dropped, the company's overall net profit, net operating income would be, what is the question? So what is the question? Drop, not drop the product. Now let us look at it. Very simple case. I have taken extremely simple problems. I have not taken very complicated problems. The idea of taking simple problems is more to give you a conceptual understanding. I am not here to train all of you on problem solving, basically cost accounting. To pick up a textbook and solve all problems out there. I am not training you for that. My training is only for conceptual understanding of the whole thing. That is where I picked up very simple and straight problems out here. Now let me look at this. Let me look at this particular option out here. Now I'll say problem number 1. Problem number 1 out here. In this particular case, I'm just going to keep this centered out here. Problem number 1. So we'll take problem number 1. What is the first option out here? The first option is basically drop the product. Second option I have is, let me not drop the product, let me continue operating the product. Let me continue manufacturing. Then of course I'm going to use one more column out here. Basically I'm going to term it as difference out there. I'm going to term it as difference out. That's all what I'm going to term it as. let us say the study sales of the product is about 2 lakh per year out there. Let us say what is the profit it makes, the sales of the product out here. If you drop the product, there is nothing out there. If you manufacture the product, sales is about 2 lakhs out there. What is the difference? Difference is going to be 2 lakhs. Let's keep that aside. My variable expenditure is going to be 140,000 out here. My variable expenditure in this particular case is going to be 140. If I drop the product, it's going to be nothing. If I manufacture the product, it's going to be 140,000 per year. That is what is the variable expenditure out here. So what happens? What is my contribution? In the contribution in this particular case, my contribution in this particular case is going to be 0. In this particular case, it's going to be, this is going to be my contribution out there. Now what happens? Then there is a fixed expense of 90,000. That's what it says. Fixed expense charged to the product is 90,000 per year. That is, if I manufacture, fixed expenditure is going to be charged to the product is going to be 90,000 per year out. The company estimates that 40,000 of these fixed expenses will continue even if the product is dropped. So, if the product is dropped, what happens? My fixed expenditure is going to be about 40,000 out there. So, what is my ultimate profit / loss in this particular case out there? So, it's going to be this minus this is going to be a minus 40,000 loss out here. So what happens? It's going to be a minus 30,000 loss in this particular case out there. So what happens? If I continue to manufacture, if I sort of continue to manufacture this particular product, I'll make a loss of 30,000. If I drop the product, my loss increases. My loss is giving me, it increases by 40, it increases by 10,000. So why? Because this is giving me some kind of a positive contribution. Because this is giving me positive contribution. Had this product started giving me negative contribution, supposing instead of this, if I say the variable cost of the expenditure was 2,10,000, then what happens? My loss increases. As long as this gives a positive contribution and there is a fixed cost which is also associated with the product, with the, if you drop the product, then you have to compare that. In this particular case, the variable cost was only 1,40,000. You saw that there is going to be, it's going to be giving me 60,000. Suppose, or if I supposing I say, this fixed cost expenditure, if I manage the product is 1,10,000, is 1,10,000 out there. Then what happens? I have to be better off by dropping the product off because my loss would have reduced by 40,000 out there. So you will always see this particular option in this particular case out there. So because by manufacturing the product out there, I incur a loss, I don't deny that. But my loss is sort of reduced by about 10,000 rupees in this particular case, whereas my loss increases by 10,000 if I do not manufacture, because fixed cost is irrelevant. Fixed cost, I am going to continue to incur about 40,000 rupees of fixed cost irrespective of whether I manufacture or I do not manufacture. So dropping, it's a very simple case. There can be very complicated case I can take in this particular case. We will go to the complicated case also, one or two of these. This is a very simple case what we do. Now let's go to problem number 2.